Have you ever heard of the phrases, money makes money, the rich are getting richer, the more money you have, the more money you make?
The first $100,000 is a bitch, but you gotta do it. I don't care what you have to do, find a way to get your hands on $100,000.
Reaching $100,000 in investment often marks a significant shift in how quickly your portfolio can grow. A lot of financial experts, like Charlie Munger, say it is the hardest milestone to reach because after that, growth speeds up very quickly. Charlie Munger once famously said, "The first 100K is the hardest." What is clear though, is that after that first $100,000, the next 100K is easy. But what really starts the dividend snowball effect, and how does it sustain your income over time? How soon can you actually see your dividends cover a major part of your expenses? Today, we're examining the mechanics behind dividend growth, leveraging insights from financial icons like Warren Buffett and Charlie Munger, who strongly support the steady, disciplined approach to investing. We'll also explore why consistent dividend reinvestment is absolutely essential for accelerating wealth, the realistic timeline to expect significant growth from dividends, and the strategies to optimize this growth. Stay with us as we break down the steps to build and maintain a solid dividend-paying portfolio, using practical, proven strategies that help you understand when and how your dividends start working harder for you. The dividend snowball effect is a powerful concept in investment that leverages the power of compounding dividends to accelerate the growth of your portfolio. This process begins when you invest in dividend-paying stocks, and these dividends are then reinvested to purchase additional shares, which in turn will generate their own dividends. Over time, this cycle of reinvesting dividends grows your holdings exponentially without additional out-of-pocket investment. At the core of this strategy is the understanding of compounding. In the context of dividends, compounding occurs when the dividends earned from stocks are reinvested to buy more stocks, which then increase the total dividend payout you receive in the next cycle. This effect accumulates more rapidly as your portfolio grows, making the initial and subsequent investments increasingly impactful. For example, if you start with a portfolio of $10,000 in dividend stocks with an average yield of 4%, you would earn $400 in dividends over the year. By reinvesting these dividends, you increase the principal amount of your investment, which means the next year's dividend payout is based on $10,400, assuming the yield remains consistent and there's no additional contributions. Over decades, this reinvestment strategy can turn modest initial investments into substantial sums, essentially using the earnings from your investments to generate more earnings. The key to maximizing the dividend snowball effect lies in consistent long-term investment in stable dividend-paying stocks, and the discipline to reinvest dividends rather than spending them. This approach reduces the impact of market volatility on the investor's growth, as the focus remains on increasing the number of shares held, which boosts potential dividend income over time. Investors who capitalize on this strategy often see their portfolios reach a tipping point where the returns from dividends alone represent significant sums of money. The important factor here is time. The longer the dividends are reinvested, the more pronounced the snowball effect becomes, emphasizing the importance of starting early and sticking to a disciplined reinvestment strategy. Reaching $100,000 in your investment portfolio is a significant milestone for many investors, largely due to the impact of compounding returns. Financial analysts often cite that once your portfolio hits this mark, each additional dollar works harder for you, due to the increased base amount that generates returns. Statistically, the journey to $100,000 can be the slowest phase of wealth accumulation. However, once this threshold is crossed, each subsequent $100,000 typically accumulates faster if the investment strategy remains consistent. For example, a portfolio starting with $0 with an annual contribution of $10,000 and an average return of 7% would take about 7.84 years to reach $100,000. But to grow from $100,000 to $200,000 under the same conditions would require just 5 years, assuming all dividends are reinvested and there's no withdrawals made. This acceleration is due to the compounding effect, where, for example, a 4% yield on a $100,000 investment results in $4,000 in annual dividends. If reinvested, these dividends themselves start earning returns, contributing more significantly to the portfolio's growth compared to the smaller base. Warren Buffett and Charlie Munger have repeatedly emphasized the importance of this phase, where discipline in reinvestment and patience start to pay off substantially, turning initial savings and investments into a self-perpetuating wealth-generating engine. Let's assume we have two investors, each following the Dividend Snowball strategy, but starting from different financial positions and life stages. Their experiences can offer a perspective on how reaching that initial $100,000 can significantly shift the growth trajectory of an investment portfolio. First, imagine Sarah, a school teacher who begins investing with a modest $500 each month. She chooses dividend-paying stocks and commits to reinvesting her dividends. In her scenario, progress initially seems slow. Achieving the first $100,000 takes about 5 years. However, once Sarah reaches this milestone, the growth of her investments accelerates due to the compounding effect of reinvesting dividends. With no increase in her monthly contribution, Sarah's portfolio doubles to $200,000 over the next 5 years. Now consider Tom, who starts his investing journey at 40 with an initial amount of $50,000. He aggressively contributes an additional $20,000 annually to his investments, also focusing on dividend stocks and utilizing a dividend reinvestment plan, or DRIP. Tom's larger initial investment and substantial annual contributions help him reach the $100,000 mark in just under 3 years. The momentum continues, and his portfolio grows to $300,000 in the next 5 years, fueled by more reinvested dividends and the growth of the stocks he holds. These hypothetical scenarios highlight how the first $100,000 acts as a critical leverage point. For Sarah and Tom, crossing this threshold significantly speeds up the growth of their investments, thanks to the increasing returns generated by reinvesting dividends. Regardless of the amount one starts with, the key strategy remains consistent. Stick with a well-planned investment approach. Reinvest your dividends diligently, and allow the power of compounding to expand your portfolio. Over time, this disciplined approach can transform modest initial investments into substantial sums, illustrating the practical impact of the dividend snowball effect. Building a solid dividend portfolio that can efficiently reach and surpass the $100,000 milestone involves strategic planning and careful selection of investments. Start by focusing on quality stocks that have a long history of stable and increasing dividends. Companies like Johnson & Johnson or Procter & Gamble are prime examples, known for their consistent dividend growth and strong market positions. Investing in such companies provides a dual benefit: secure dividends and potential for growth. Diversification also plays a critical role in constructing a durable portfolio. Rather than concentrating all of your investments on a few high-yield stocks, spread your funds across various sectors such as healthcare, consumer goods, and technology. This strategy helps mitigate risk, as poor performance in one sector may be offset by better performance in another, thus stabilizing your overall income. Another effective strategy is to utilize the dividend reinvestment plans. DRIPs allow you to automatically reinvest your dividend payouts back into additional shares of the stock, compounding your returns and accelerating the growth of your portfolio without requiring any active management on your part. It's also essential to regularly monitor and rebalance your portfolio. This involves evaluating your holdings to ensure they continue to align with your financial goals and adjusting them as necessary. This might mean selling off underperforming stocks or increasing your stake in sectors that show promise. Lastly, try to incrementally increase your investment contributions over time. As your financial situation improves, boosting the amount you invest can significantly accelerate your progress toward the $100,000 mark. Thanks to the compounding effect of these additional investments and the reinvested dividends, every extra dollar invested not only grows itself, but also enhances the growth rate of your entire portfolio. By adhering to these strategies, you're not just randomly assembling a collection of stocks, but building a thoughtfully curated portfolio that is geared towards long-term growth and sustainability, pushing steadily towards and beyond that initial $100,000 goal. But investing towards a $100,000 milestone isn't without its challenges. Market volatility is one of the main hurdles every investor faces. Stock prices fluctuate due to various factors, including economic changes, political events, and market sentiment. During these periods, it's essential not to panic. Instead, maintain a long-term perspective and keep investing consistently, as these downturns may provide opportunities to buy quality stocks at lower prices. Another common challenge is psychological. Watching your portfolio dip significantly can be disheartening and might tempt you to sell off assets prematurely. Overcoming this requires a disciplined approach to investing, staying focused on long-term goals rather than reacting to short-term market movements. Gaining knowledge about market cycles and past market recoveries can help you feel more confident when things are bad. Lastly, maintaining investment consistency can be tough, especially when faced with personal financial demands or economic downturns. To navigate this, prioritize your investment as a fixed expense in your budget. Treat it like a non-negotiable bill that must be paid each month. This approach helps in building investment habits that can withstand both personal and economic pressures, guiding you steadily towards your financial goals. Once an investor has accumulated $100,000 in their dividend portfolio, understanding how long it will take to potentially live off dividends becomes a significant focus. The calculation depends on various factors, including the dividend yield, growth rates, and whether dividends are reinvested. Assuming you have a portfolio worth $100,000 with an average dividend yield of 4%, you would initially generate $4,000 in annual dividends. If these dividends are consistently reinvested, the compounding effect not only increases the annual income over time, but also accelerates the growth of the portfolio's total value. For example, if your goal is to live off a yearly income of $40,000 solely from dividends, and your dividends grow at an average annual rate of 6% due to increasing payouts from the companies in your holdings, here's how you might approach it. First off, starting dividends. $4,000 annually from a $100,000 portfolio at a 4% yield. Second, growth assumptions. Dividends are reinvested, and the portfolio appreciates due to both reinvestment and organic growth of stock prices. Third, additional contributions. Assuming continued annual contributions of $10,000. Using these assumptions and aiming for an average total return, including dividend reinvestment and capital appreciation, of around 10% per year, it would typically take about 14 years for the annual dividend income to grow from $4,000 to approximately $40,000. This timeline allows for substantial growth due to the power of compounding, assuming steady dividend growth and no major market downturns. After 14 years, with consistent investment and reinvestment strategies, the estimated portfolio value would be approximately $659,500. This calculation assumes an average annual return of 10%, continuous reinvestment of dividends, and yearly contributions of $10,000. This substantial growth from the initial $100,000 highlights the power of compounding returns and strategic investing over time. If someone starts investing at the age of 24 with these parameters, they could potentially begin living off their dividends at the age of 38. This scenario assumes disciplined investing, consistent reinvestment of dividends, and regular contributions to the portfolio. It highlights the importance of starting early to maximize the effects of compounding, making it feasible to sustain one's lifestyle through investment income alone by midlife without needing additional work income. How has your experience with dividend investing been? What goals do you set for your dividend income? Share your thoughts and strategies in the comments below. Remember, consistent investment and patience are key to seeing your dividend snowball grow. Don't forget to like, subscribe, and hit the notification bell for more insights into making your investments work for you.